how do we win with the black hole?
The investing black hole is a growing trend that is sucking in nearby funds, killing portfolios that use old investment strategies like Ray Dalio's funds.
No matter what the timing is going on, if you change your strategy, it could work. And the point is that his strategy worked, as in past tense, but today it's not.
Which have lost over 70 billion. To stay ahead, investors must either use this black hole's energy to grow their portfolio or risk getting sucked inside and never escaping to the life they dreamed of. Mark Moss, a partner of a Bitcoin AI-focused VC hedge fund and strategic advisor to a new publicly traded company, discusses the concept of quantum waves.
During these quantum waves, or I call them Q waves for short, not only do they change humanity, but they drive all financial markets. So what's driven the markets for the last 50 years? Telecom, personal computers, and internet, represented by Jeff Bezos. What drove the markets for the 50 years before that? Well, it was Ford, GM, GE. What drove the markets for 50 years before that? It was steel, it was railways, it was oil, and you start to get the drift. Now, of course, you can put your money wherever you want. You can put it into bonds, you can put it into whatever, real estate, but the majority of the wealth was made here for the last 50 years, just like the majority of the wealth was made there for the last 50 years. That represents the black hole.
These quantum waves are not technologies, but technological revolutions that change the course of humanity and drive all financial markets. The major wealth generated during these waves is represented by the microprocessor, which brought telecommunications, personal computers, and the internet. The fifth wave, which is now entering the sixth wave, is represented by Jeff Bezos, Ford, GM, GE, steel, railways, oil, and more. Investors should focus on sectors like Intel, which started the microprocessor revolution, which led to the cluster of technologies that are currently driving the market. By understanding the investing black hole and investing in the right sectors, investors can stay ahead of the curve and achieve their financial goals. The concept of investing black holes, which are areas where investors are forced to invest due to the debasement of their money. This is because the real rate of debasement is the rate at which consumers lose their value, and investors must beat this rate to maintain their wealth. The hurdle rate is the rate to beat when borrowing capital for business purposes, such as buying new equipment or building a new building. The hurdle rate is not CPI, but the real rate of debasement. The real rate of debasement has been averaging 10% per year since 2019, with the Fed showing a good representation. The hurdle rate is about 13.6%, with a risk premium of 2 to 3%. This is important because investors may see their index funds, 401ks, and mutual funds increasing in nominal value but not feeling more rich. Using CPI inflation is an all-time high, while Bitcoin is double the official government CPI data. Actual inflation is the rate of debasement, not CPI. By understanding these factors, investors can better manage their investments and maintain their wealth. The investing black hole is a problem that arises when considering different asset classes and their performance. From 2011 to 2024, the S&P 500 was ranked highest to lowest in terms of annualized returns. Bitcoin was the top performing asset class with a 144% annualized return. The second performing asset class, NASDAQ, returned 17.5%, better than the hurdle rate of 14.5%. The fourth place was the S&P 500, which is where most investors buy into index funds, 401ks, and mutual funds. Gold was the lowest performing asset class, with an average return of 2.4%. This is still way below the hurdle rate, making it difficult to invest in it. It is important to consider only two different asset classes when investing, as they all have different performance and compete against each other. Global liquidity, which includes money, currency, and credit available globally, moves on cycles and has a correlation between 90 to 95%. If you buy the S&P 500, you are averaging 12.5%. However, if you buy the S&P 500, you are not getting ahead. The same is true for US real estate, where prices are going up and the debasement or the amount of monetary expansion moves almost perfectly. Homes are starting to catch up, and they are a perfect proxy for the rate of inflation. However, homes do better because there are other ways to make money with homes, such as leverage, loans, tax efficiency, and write-offs. The black hole starts when the correlation between global equity and inflation hedges, gold and Bitcoin, is down to about 80%. This means that these assets have different sensitivities, with gold having a sensitivity ratio of 1.49 and Bitcoin having a sensitivity ratio of 8.95. For every 10% increase in liquidity, gold goes up by about 14% and Bitcoin goes up by about 90%. Understanding these asset classes is crucial for investors, as they can lead to billions of dollars in losses. Ray Dalio, one of the most famous investors in the world, illustrates the importance of understanding these factors when investing. Ray Dalio, the founder of Bridgewater Capital, is known for his risk parity strategy, which aims to buy a mix of uncorrelated assets across all economic conditions. This strategy has worked well in the past, but today it is not as successful. Dalio's all-weather portfolio and risk parity portfolio have both returned 7.65% year-to-date and 5.29% over the last 10 years, with the hurdle rate being 14.5%. However, the S&P 500, which is already losing to the hurdle rate, has done 17.25% year-to-date and 7.6% over a 5-year return. The S&P 500 has done 17.5% over 30 years, while Dalio's portfolio has done 4.3% over a 10-year period and 10.9% versus 5.29%. This means that the S&P 500 is losing big, with an average of 7.43% over 30 years and massive drawdowns. Investors are losing faith in Dalio's strategy, as it is not necessarily safe. His strategy is wrong for this time, as investors are pulling out their cash after 5 years of subpar returns. The next decade in markets is unlikely to resemble the last, as the only time the risk parity strategy was successful was during the Great Financial Crisis, and it worked great in the past. However, the current market environment is unlikely to resemble the same one, as the next decade may not be as successful. In conclusion, while Dalio's risk parity strategy has worked well in the past, it is not necessarily safe for the future. Investors should consider alternative strategies and consider the potential risks and returns associated with different investment options, diversifying investments and avoiding the investing black hole. They argue that many investors are focusing on a well-rounded portfolio, which includes 60% stocks and 40% bonds. However, this approach can lead to underperformance in asset classes, such as bonds and real hurdle rate bonds, as most financial advisors drive their yacht by underperforming equity mutual funds. This is because the average investor's investment in a fund over the next 30 years turns into about $140,000, but they take about 100 of it. There is an investing black hole where every 50 years, a quantum wave window opens up a Q wave, and the only place to invest is in that. To achieve big returns, investors should focus on the Q wave and not other types of investments below Bitcoin and NASDAQ. The black hole is not a single technology, but a cluster of technologies that converge, such as Bitcoin 2.0 and decentralized wallets. Companies like hedge funds and public companies that build on and around this intersection are investing in these technologies. The need for large amounts of copper for AI and other technologies. These hidden backdoors can be overcome by investing in companies that are building on and around this intersection and using decentralization,